So types of funds, which fund to pick? There are funds that focus on stage, early growth late. There are sector-focused funds. Largely in India, most VC funds are tech. Some of the Indian funds, including Helion and Nexus, will do services as well. Generally folks like us at Canaan, we've tended to shy away from, say, retail formats, chain stores, things like that. There are a few healthcare funds now in India. There's many infrastructure funds, and there's been our share of real estate funds as well. And there's a few corporate VCs. Intel Capital's been very active in India. I've seen a few more guys running around, and generally, they used to do slightly later stage deals, but now we're seeing them doing a few early stage deals as well. So picking a VC, it's a little bit like getting married. In fact, it is very much like getting married. You want to pick carefully. You want to try and create, the right kind of chemistry. You're going to see this person a lot, whether you like it or not. So make sure that you establish a great relationship. You don't have to love your VC. They need to respect you and you need to respect them, right? And I think that works if you have to be in this for a 5 to 7 year period. Look for domain knowledge, look for relationships. Most of us who are in this business have come from some other industry. So, people may have worked in telecom, media, tech, enterprise software. So look at the fund, try and identify a specific partner if you can, because more often than not, if somebody comes to me with a deal that I know nothing about, generally speaking, I'll pass on it, right? So you want to kind of go deep into, these funds and try and understand, look, what kind of deals has this person done? What is his area of interest? What is his area of expertise? And try and create that fit, right? Because it's not just about getting money from a fund, it's about who in that fund is going to be your champion for the next 5 to 10 years, right? Do they have the ability to provide follow-on capital, right? This one is tied to the next point, which is where are they in their fund life? So if you're a really early stage deal, typically what happens is funds will slow down on doing very early stage investments as they get to year 4 and year 5, because they may or may not be able to top up, or you may be fighting against other investments for reserves. So the way our model works is if we invest 5 million, at that point in time, we will typically reserve another 5, 7, 10 million as a follow-on. But as the fund starts to grow, and companies pull ahead, those reserves are fungible. So people start to pull on those reserves and the winners start to get more capital. So I think you want to be mindful of saying, look, does this fund have the right size and where are they in their life cycle? So for instance, as we think about our life cycle, we will probably be doing slightly more later stage deals than doing very, very early stage deals at this point. But every fund will go through that evolution every 5 to 7 years, right? So what can you expect from a VC? Don't expect the guy to know the business better than you, right? That's very simple. If we knew the business better than you, we'd be running it. So I think just be mindful of the fact that our primary job is being an investor, not necessarily being the owner of the business. We don't want to run the business, right? In fact, the companies, if it's not doing well, is when we end up spending a lot of time with it. But what you will get is you'll get a board, and oftentimes that board will help you figure out what are the critical milestones and what's the hard problem to solve. You will get customer contacts. Most of us tend to meet hundreds of people in a year, and invariably, through that we build networks that are pretty wide. And we oftentimes can pull in strategic advisors. So if you're doing stuff in a particular market or a particular domain, we may not know it, but we can help you find somebody in there. With that comes a formal board. So that brings a certain discipline to how you run your business, what you report. We'll typically bring in a real chartered accountant. We'll get into the process of doing, internal audits as the company scales, things like that. And then, that becomes really important if you want to ever raise follow-on financing. That becomes much more important for later stage investors. So the trade-offs, right? So what do you give up? This is not, it's not about being the solo operator, right? So I think you have to recognize that now you have the responsibility of carrying an investor. You will be responsible for managing to a budget. Oftentimes we let the founder come up with a budget, right? It's not for us to decide the budget, but then, expect them to manage to that. it is, certain decisions around key hires, key fires, should you open up a new line of business, things that we believe are materially important to the company will end up being decisions that are taken by the board. And then finally, you will give up some ownership, right? I think we're in this business to help create a large outcome, and that's, what the trade-off is. So, you should feel comfortable giving up some ownership. Now, we've seen people actually raise seed money and give up a lot of their companies. So my counsel would be, depending on how much money you're raising as seed, try to keep your dilution to under 20%. Because if a VC comes in after a seed investor, he will typically want another 25 to 35%, right? So one of the things you should do is manage your seed round financing. Sometimes people go and give half their company in the seed round, right? And that's not a great idea. So just be mindful of the fact that there will be more and more dilution. It'll typically happen at higher valuation. So you don't have to it's not exactly like, your share will get half every time, but just keep in mind when you do your seed round, don't dilute excessively. The other phenomenon we're seeing, say, in markets like the US is, and I think it'll come in India as well, is you'll raise a round, you want price the round, and you'll say, look, I will give you an ownership equal to a discount on the next round of financing. So let's say you can't agree on whether it's 1 million or $500,000. So you tell the investor, look, I'll probably bring money in the next 6 to 12 months at a X $1 million valuation, and I will give you a certain discount on that. Depending on what that investor's appetite is, that could be as much as 50% discount, or it could be as little as 15%, right? It also depends on how far you are from raising money. But a lot of the startups we're seeing come out of the incubators are raising money like this. So it's a $200,000 to $500,000 round, typically priced when the VC round happens. And we can talk about that in more detail if you guys want later on.